Picture this. You're at the grocery store. You've got a loaf of bread, some milk, and maybe a cheeky chocolate bar. The total is $6. You swipe your card, the transaction goes through, and you head home. But the next morning, you open your banking app and see a giant red negative number. That $6 snack just cost you $41.
Wait, the math isn't mathing there, Finn. You spent $6. Where did the rest come from?
The dreaded overdraft fee. It's the most expensive $2 you'll ever borrow. See, your account actually had $4 in it. You were $2 short. Instead of just declining the card at the register, which cost everyone $0, the bank covered you. And for the privilege of them lending you $2 for 12 hours, they slapped you with a $35 service fee.
That is a 3,500% interest rate if you look at it as a loan. If a payday lender did that, people would be rioting in the street. But because it's a fee and not interest, it slips under the radar.
That's a very expensive loaf of bread.
It's a massive industry, Zara. We're talking billions of dollars a year in pure profit for banks. And the wildest part is how they actually process your money behind the scenes to make these happen more often. It's not just bad luck, it's the way the plumbing of the banking system is built.
Okay, we need to peel this back because most people think an overdraft is just a mistake, but it's actually a highly engineered financial product that you might have accidentally signed up for without realizing it.
Exactly. Let's start with the available balance versus current balance trap. This is where most people get tripped up. Have you ever noticed that your bank app shows two different numbers?
Every time! I'll see current balance $100 and available balance $40. It feels like the bank is gaslighting me about my own money.
They kind of are. The current balance is the total amount of money actually in the account, but the available balance is that total minus any pending transactions, like that gas station hold or the dinner you bought last night that hasn't fully cleared yet.
So if I see $100 in my current balance and I spend $50, I should be fine, right?
Nope. If you have $60 in pending holds, your available balance is actually -10. If you spend that $50, the bank triggers the overdraft fee because, in their eyes, that money was already spoken for. You're essentially spending money that's in a queue.
That feels like a trap. If the money is still in the account, why can't I use it?
Because of how the system works. When you swipe your card, the merchant sends an authorizations request. The bank says yes, they have the money, and they put a thumb on that cash so you can't spend it elsewhere. But the actual movement of the money, the settlement, can take days. The bank charges you the fee based on the moment of authorization, not when the money actually leaves.
So, how did we get here? Did it always work this way? Because I remember my parents saying their cards just got declined if they didn't have the cash.
That's a great point. We have to look at 2010. Before then, banks could just enroll you in negative balance protection automatically. You'd open an account and boom, you were opted in. But after the financial crisis, regulators stepped in with something called Regulation E.
Regulation E? Sounds like a low-budget 50s sci-fi movie.
It's basically the rule book for electronic fund transfers. The big change in 2010 was that banks could no longer charge you these fees on spending with your card or getting cash from the ATM unless you said yes first.
Wait, so if I never signed anything, my card should just say declined at the store?
In theory, yes, but here's the kicker. Banks marketed the hell out of negative balance protection. They made it sound like a premium feature. They'd say, don't be embarrassed at the checkout line. Sign up for protection so your transactions always go through.
Protection. That's clever branding. It's not protection for you, it's a revenue stream for them. They're protecting you from the minor social awkwardness of a declined card by charging you the price of a fancy steak dinner.
Precisely. And for a lot of people, especially when they're moving fast or opening accounts online, they just click yes to all the terms and conditions. Suddenly, they've given the bank permission to charge them $35 for a $2 coffee.
But what about checks or recurring bills? Does Regulation E cover those?
Great catch. It doesn't. Regulation E only covers those everyday transactions like the grocery store or the ATM. If your rent check bounces or your automated electric bill hits an empty account, the bank can still charge you an NSF fee without you opting in.
So you're getting hit from both sides. But Finn, I've heard rumors about something even darker. Something about the order in which they process the transactions?
Oh, you're talking about transaction reordering. This is the real villain of retail banking. Imagine you have $100 in your account. Throughout the day, you make 4 small purchases: a coffee for $5, a snack for $5, a bus pass for $5, and a magazine for $5. Total spent $20.
Okay, I still have $80. Easy.
But then, at the very end of the day, your phone bill hits for $110. You are now $10 short. Now, a fair way to do this would be to process the 4 small $5 item first. You have $100, you spend $20, you have $80 left. Then the $110 bill hits, you go over by $30, and you get 1 negative balance fee.
That sounds logical. Sure, it's annoying, but logical. 1 mistake, 1 fee.
But some banks used to, and some still try to, reorder those transactions from highest to lowest value at the end of the business day. They would process the $110 phone bill first.
Wait, why?
Because if they process the $110 first, your $100 balance immediately goes to -10. That's 1 fee. But now, every single one of those tiny $5 transactions you made earlier in the day is also hitting a negative balance.
No way. So instead of one $35 fee, you get 1, 2, 3, 4, 5 fees?
Bingo. $175 in fees for being $10 short. They effectively maximize the number of times you trip the overdraft wire.
That is wild. It's like a financial rake in the grass. You step on one and the rest just keep hitting you in the face. Is that even legal?
It's been a massive legal gray area. There have been huge class action lawsuits over this exact practice. Many big banks have moved away from it because of the bad PR and government pressure. But it's not strictly illegal everywhere. Some banks argue they process large payments first, like mortgages or rent, to ensure your most important bills get paid.
Convenient how their helpful ordering also happens to be most profitable ordering for their shareholders.
Just follow the money, people.
Exactly. And this is where we see the big split in the banking world today. You've got the traditional giants who still rely heavily on these fees, and then you have the neobanks or digital-only banks.
I see ads for those all the time. No overdraft fees ever. Is that actually true, or is there a catch?
A lot of them have built their entire brand on being the anti-bank. Since they don't have physical branches or thousands of employees to pay, they can afford to lose the fee revenue. Instead of charging you $35, they might just decline the transaction, or they might offer a Spot Me feature where they give you a small interest-free buffer of, say, $20 or $50.
So why doesn't everyone just switch?
Tradition, mostly. People like having a physical building they can go to if something goes wrong. Plus, big banks offer things like specialized mortgages, wealth management, and robust fraud protection that some smaller startups are still catching up on. But the pressure from these neobanks is forcing the big guys to change. We're actually seeing some major US banks start to drop or slash their negative balance fees just to stay competitive.
It's like the Netflix effect, but for your checking or current account. The old guard has to adapt or die. But for the people who are stuck with a traditional account right now, how do they avoid the fee cascade?
The first step is checking your opt-in status. You can literally call your bank or use the app to opt out of overdraft coverage for debit transactions. Yes, your card might get declined at the grocery store if you're short, but a second of awkwardness is way better than a $35 penalty.
And what about the pending trap?
Set up alerts for when your balance gets low. Most apps will ping your phone the second your balance drops below 20 or 50 bucks. It gives you a chance to transfer money from savings before the next transaction hits. And if you do get hit with a fee, call them.
Wait, you can just ask them to take it back?
If you aren't a serial overdrafter, most banks will waive 1 or 2 fees a year just for asking. It costs them more to lose you as a customer than it does to give you that $35 back.
So the real takeaway here isn't just don't spend money you don't have. It's understand the rules of the game so the bank doesn't profit off your timing.
Spot on! The system is built on ledger time, not real time. If you know that, you can stay ahead of the fees.
It's crazy how much of personal finance is just knowing which hidden buttons to unclick.
It really is. And once you stop paying for the privilege of spending your own money, you've already won half the battle.